We are Bronco Asset Management, and we'd like to introduce you all to First American Financial, a company that has posted stellar historical results off of favorable market and economic trends that we believe will begin to struggle given our unfavorable future outlook. As such, we at BAM issue a sell recommendation for First American Financial with a valuation of $67, which is an 8% downside under the stock price as of January 28th. This decision is based on three main theses: expected decelerating revenue growth of the company, our negative real estate market outlook, and their poor relative performance when compared to its competition. First American's business model is highly focused in the title insurance industry, as title accounted for nearly 93% of 2020 revenue. Because of this, the company is greatly reliant on new mortgage and refinance volume, which creates cyclicality to mortgage rates, supply, and pricing. Among its competitors, First American has experienced steady loss in title insurance market share over the last 7 years, and we expect the company to lose its top spot. Starting in 2014, the company has deployed considerable capital in hopes of reducing costs by automating human processes. Since then, FAF has been granted 15 patents related to digitizing its title search. Externally, acquisitions were intended to bolster the company's data gathering and analysis arsenal. It's not always clear where improvements attributable to tech investments have led to gains. However, improvements in accuracy and efficiency in the title insurance process will be visible through the company's loss and expense ratios. Loss ratio has trended downwards, but there were inconsistent increases in 18 and 20. In addition, efficiency gains were questionable, given an expense ratio that hovers around 39% over the same time frame. Given a shrinking market share, high concentration in title, and unrealized gains from tech, we see the company, while having no clear competitive disadvantages, no clear advantages either. Overall, that was a summation of First American's business model and key competitive positioning. For a deeper dive into our expectations for the real estate market, I'll pass it over to Cam.
Thank you, Jonas. The commercial purchase market is set to recover from key limitations, namely Omicron, which has shifted return to work expectations for the first quarter of 2022. Although home occupancy has yet to recover, given employee desire to work from home, other commercial sales transactions are expected to pick up materially as COVID cases decline. The residential purchase market demand has been high due to strong supporting demographic drivers. In 2021, almost 50% of the US population accounted for millennials and baby boomers. Buyers within the purchase market who fell within the same categories made up almost 70% of all transactions. As a result, the title industry captured a large volume of premiums from purchase originations. However, home prices soared to almost 4.5 times annual income during the same period. In 2020, home prices increased by 13%, but household incomes declined by 2%. Rising mortgage rates should provide some downward pressure on prices, but current levels of demand have made recent downward pressure negligible in comparison. Other headwinds are also beginning to take their toll. Mortgage originations for residential homes began a steady decline throughout most of 2021. We believe this is due in large part to limited supply of lumber and other blockers to construction. Existing home inventory bottomed to under 1 million sales in December, the lowest level we've seen in decades. We believe that these trends are likely to continue well into the first quarter of 2022. And this year, FAF will no longer have the large volumes of refinances to support their top line. Also, the hikes provide an incentive to homeowners to hold on to the newly refinanced homes, further reducing purchase market activity. Victor will now present an analysis of First American's financials.
Moving into First American's financials, we expect First American to perform similar to the industry in the sense that they will experience very small growth in revenue. We project First American to have a CAGR of 1.7 from 2022 to 2025, which is significantly slower than the historical CAGR of 7.1%. In 2021, First American had an unprecedented boom in revenue that was driven by increases in title orders closed and commercial real estate deal volume. However, this growth may not be sustainable because of estimates of decreasing refinancing demand, as well as stagnant mortgage originations, which affects title orders closed. Looking at the bottom line, net income is anticipated to grow significantly slower than historically. In 2020, the company had large expenses to increase the amount of proprietary technology used in an effort to increase margins and thus increase the bottom line. When compared to competitor companies such as Fidelity National Financial, First American's proprietary tech is still lacking. Furthermore, First American has underperformed in net income growth, and we expect this to continue. Switching gears to EPS and dividends per share, there are noticeable differences in the growth. This is due to the commitment from First American to continue their growth or to grow their dividends, whereas EPS has followed the inconsistent growth of net income. First American has delivered on its dividend growth with a CAGR of about 10% since 2016, despite years of slowing revenue or decreasing net income. The company has an average payout ratio of around 33%, and we anticipate the payout ratio to grow to 36% in 2025. Dividend growth may be constrained by a growing payout ratio due to the slower EPS growth compared to dividend growth. Thus, we anticipate a 6% growth in dividends following 2021. I will now pass it to Michael to discuss our ESG section.
Our ESG analysis incorporated many factors. To begin, we conducted a survey asking market investors to select issues important to their investment analysis, which we then took into consideration and found governance issues were most important. On the environmental and social side though, as listed, First American checks all the boxes. However, onto the governance, First American raises questions. Within their management at the executive level, the bulk of the team is made of new hires, so we don't have a great track record of this current team's performance. Secondly, on both the board and the executive team, there's minimal amounts of diversity, and the board's chairman is also the former CEO and president, Parker Kennedy, who has deep roots in history of First American, and we don't believe should be considered an independent member nor the chairman. We believe a more diverse set of teams will benefit First American, and research has proven teams with high amounts of diversity are more likely to succeed. First American also gave us concerns within their information security due to a recent data leak, which raises questions on how well can they protect sensitive information. We also took note of First American's well above average compensation across the CEO, executives, and the board. Overall, we don't recognize their current efforts strong enough and includes increased risk and lagging behind competitors once again. Now I'll pass it on to Joy to discuss our valuation.
Thanks, Michael. Combining our company and industry analysis, we arrive at a target price of $67, using the weighted average of 30% in the free cash flow to equity model, 30% in the two-stage dividend discount model, and 40% in the price to book relative valuation. With First American's price at 73.23 as of January 28th, this suggests a potential downside of 8%. Now I will explain each of our valuation models in detail. For a relative valuation, we have chosen the comparable companies within the title insurance industry. By taking the average price to book ratio of our selected comparable companies, we arrived at an industry multiple of 1.3. Then multiplying this average ratio by First American book value per share to return a target price of $67. We strategically give this valuation more weight in our final target price because it is a better representation of the title industry. Our two-stage dividend discount model utilized a bottom-up beta calculated from the median levered beta of First American's comparable firm listed in BIGs and GIGs. The growth rate of 6% during the high growth period was determined based on our financial forecast. The perpetuity growth rate of 1.5% was determined based on our forecasted long-term industry growth.
2 minutes.
Return a target price of $59 with a 19.68% of potential downside. Our free cash flow to equity model used our forecasted net income minus the difference in minimum equity to keep the financial strength and beginning equity. Since First American targets a debt to capital ratio of 18 to 20% to meet the target financial strength ratings, the minimum equity required was calculated based on our forecasted long-term borrowings. As a result, this valuation model gave us a target price of $76 with a 4.37% of potential upside. Now I will pass it back to Michael to raise there our key investment risks.
Now to retell our risks, we found many factors that can disrupt First American's ability to carry out its business model and are taken into account within our valuation and analysis. However, we identify housing supply as a main risk on the industry side and governance on the firm side. Housing demand is projected to remain relatively stable, but supply is not expected to catch up anytime soon. This should lead to lower amounts of transactions, which would greatly affect First American's top line. Secondly, as we talked about earlier, we believe First American still operates much like a private company and has many flaws within their governance, which will ultimately affect shareholders and increase risk to its business. In conclusion, we reiterate our sell recommendation based on 3 key factors: the salary and revenue growth, a poor market outlook, and lagging behind their key competitor. We come to a target price of $67 and see a potential downside of -8%. Thank you, and we will now take your questions.
All right, guys. Alfonso, you ready to hit the reset time?
Yep. Ready.
All right, judges, whenever you're ready. Alfonso will begin as soon as you ask the first question.
All right, well, I'll get started. Thank you all. That was great research. And I think what I'm kind of trying to understand is what are some of the other competitors there in the title business? What are they going to do differently? Or is this really more of a sell recommendation for anyone that's in the title business?
This is interesting because for First American, they are 100, like almost 100% into title insurance, whereas other companies such as Fidelity only have a small portion of their revenue in title insurance, and they have other insurances that they have in their business model.
I see. So they're just not as diversified.
Correct.
And the other question I had, if you go back to page 9, I was looking at some of the numbers when you were looking at the, their growth rates. Did you look at kind of what their more historical growth rates had been, kind of 2019 and prior? We obviously just been in the last couple of years with some, really strong growth in this area that, it's unlikely it can continue at this rate, but I'm just kind of curious if, what some of the averages might have been prior to 2019.
I don't have the numbers off the top of my head, but we did look at numbers from 2014 to around 2016-ish. And in my opinion, it wasn't very representative of where the company is currently. So we chose to go from 2017 to 2020 because that's where they made a lot of changes in their business, or not business model, but more of the changes in a lot of what they're doing with the tech and stuff.
In addition, we believe that lowering mortgage rates were a strong benefit to their top line growth throughout the past couple of years. So for the future, with rising mortgage rates, we see that as a deterrent.
Right. Okay, that's it for me.
Thank you.
Who wants to go next?
Go ahead, Ray, if you'd like.
No, you go first, Priyanka. I'll go after you.
Okay, thank you, Ray. Well, Jonas, Joy, Cameron, Michael, Anthony, Victor, excellent job. So awesome. Thank you. I have a few questions. I loved that you did an ESG survey. That's great. Could you share what is the percentage of women on the board that you think is ideal for a company like this? And what is the current percentage, if you know, for First Trust or First American Finance?
Thank you for the question, and I believe Joy can answer that for us.
Yes, so actually First American, they are doing a great job in providing programs for women to work in this industry. In 2021, they were ranked as one of the best places to work for women, and they're ranked since 2016. And they also have a program called Women in Leadership Program, which promotes professional growth opportunities for women within this organization since 2012.
Thank you, Joy. That's helpful. And I'd like somebody other than Joy to answer this question. What's the percentage of women on the board, and what percentage do you think is a good percentage from a ESG perspective?
Currently, women make up 22% of the board, which we believe should be, which we believe is underperforming compared to other industries, not just the title itself. We believe a more diversified board would be beneficial for First American.
Okay, thank you for jumping in, Michael. And then Jonas, you mentioned that there's no clear disadvantage that the company has. Then why do you have a sell recommendation? Or why does the team have a sell recommendation if there's no clear disadvantage?
So when we're talking about the, excellent question, by the way, we talk about the no clear disadvantage. That's in terms of the competitive positioning. Ultimately, the title insurance industry offers very similar products. And for the most part, they are trying to do the same things with the products they offer in terms of pricing and to some degree market share. It's very competitive with Fidelity. Because of that, we see it very stalemated, but also we're offering a sell recommendation because that stalemate is starting to become broken as we see the market share declining for First American.
Okay, on your DCF model that you talked about, how did you aggregate? I know most of the income comes from one sector, but how did you aggregate? How did you use their other sources of revenue, and what was the cost of equity you used?
I could answer the cost of equity question first. So the cost of equity, we used the implied equity risk premium from First of the Mogens model, and we also used a bottom-up beta that we calculated. It can be found in the appendix. So we used a bottom-up beta is of 1.28, and then we used the 10-year treasury as of January 28th, and that was 1.78%. And for the revenue component, I will delegate that to Victor to answer that question.
I'm sorry, can you restate the question, please?
Sure. So in the DCF model that you used, this is a company that has different revenue streams. So how did you factor that into your DCF? Was there a particular model you used, like sum of parts or other, models that are available? Just curious as to how you did that.
Yeah, so when it came to looking at the revenue streams, we looked a lot on company guidance on how they explained how the revenues are affected. So for example, investment income was affected by rates going up. So the investment income section, they have smaller equity portions compared to fixed income. So we're expecting a lot slower growth in the investment income coming up into the next couple of years. On top of that, they were really reliant on refinancing for the past 2 years. So it was a combination of just a lot of different company guidances and what they felt that they were benefiting from during this past couple of years that we saw would affect their revenue in the future.
Thank you. And I'll turn it over to Ray. If there's time left over, I can come back with more questions.
Thank you. Again, well done, guys. It's a good presentation. Well, clear slides and well thought through. There were a couple of things missing, which concerns me if you have a cell rating. Firstly, can we just go back to look at the loss ratios? Could you explain to me that a company that has such a consistent loss ratio of around the 10% level that you're showing me, how it's losing market share, and why is its loss ratio so much lower than ORI? Why is alternatively, why is ORI so much higher? What's the mix of business?
So yeah, excellent question. First of all, I'll tackle the ORI. ORI is a smaller company and may not be benefiting from the same economies of scale within the company that its more larger competitors have. However, it's still one of the major players in the market. And in terms of, if you could like restate your question about, was it about the consistency of the loss ratio?
Yeah, the consistency of the loss ratio. Why would you expect it to be worse? Because you're putting a cell on. So one of the reasons I look at a cell is because its loss ratios will be increasing. What would substantiate an increasing loss ratio if that's one of the elements you're looking at?
Right. So when we look at this industry, they're very cyclical to the real estate market. So we would like the company to look for revenues of growth past the point of the last 2 years, which has been driven by a lot of refinance originations and mortgage originations, which we don't expect to continue. So if we would look for a company that continues to grow, and one of these avenues that the company has heavily invested into is their insurance tech capabilities. And since they've been investing a lot into it and they're not growing their bottom line as a result of reducing costs, we don't see this as an advantage for them. We see it as a negative.
Okay, I don't think you answered the question. I asked you why the loss ratio might change, but let's move on to other questions. The second, I think, Victor, you mentioned that the investment income will fall over the period going forward. I see a different picture. I see increase in short-term rates, and for every 5 basis points or 1% increase, I don't really remember the logic, they could have a $15 to $20 million of investment income from deposits because they have an escrow business, they got a deposit business. So where's that in your figures? A rising interest rate curve will be very good for them on that side.
It's going to be mixed actually, because the investment income segment is made up of net investment income and also net realized gains. So the net realized gains kind of offsets the net investment income. Investment income is what's benefiting from that 15 to 20 million for every, I think you said 5 basis points. That was from company guidance in terms of how well the equity is going to do when the rates change. It gets offset by the fixed income section because they're expecting to lose money for every 100 basis points it moves up. So we adjusted it because it's not going to jump 100 basis points immediately. So we've adjusted it so it lowers gradually, but we do have kind of offset of their equities
Time's
to
up.
fixed income.
I had much more questions. Thanks, guys.
Thank you, guys.
Thank you.
Great job
Thank you for
today,
your
everyone.
questions.
Great, thank you.
Thank you.
Amazing job.
Good afternoon, everyone, from the UC Riverside team. Today, we are presenting First American Financial, which is one of the leading title insurance companies in North America. We believe that First American's strategy is poised to stimulate future growth. Therefore, we issue a buy recommendation with a target price of $94 with potential upside of 24% as of February 9th. First American Financial operates mainly in two segments, title insurance and specialty, the majority of which is title insurance, comprising 92% of overall revenue. From their title segment comes two types of activities, refinance and purchase. Couple First American's dominant stance in market share, strong revenues in recent years, and a product that is nearly required by every lender to refinance or receive a mortgage, the company portrays a number of positive investment indicators already. Cementing First American's competitive position, the company has steadily decreased their title loss ratio over the years, especially outperforming two peers when looking at their median loss ratios, and we believe that FAF will only continue to decrease this number in the future. Additionally, when comparing First American to its competitors, it becomes clear that the company is a pure play on the title industry. The majority of its revenue comes from title, with management stating their intentions to become the leading title insurer in the nation, unlike its competitors who either supplement their revenues from countercyclical industries like Fidelity National and their acquisition in F&G, an annuity business, or Stewart, who is only 1/4 the size. These differences drastically change the financial statements of each company. So looking at their debt to equity ratio, First American yet again comes out on top, being 38% better than the industry and 4 times better than its closest competitor, Fidelity, which holds a 32% market share. And now on to investment thesis.
With First American's position in the real estate industry being well established, connected, and defined, we believe they are worth investing in due to the following drivers. 1. First American's strong revenues despite interest rate increases. 2. A positive economic outlook on the industry market. And 3. First American's disciplined M&A strategy. Let's start with the first one, their strong revenues. Historically, First American's revenues have been steady and rising, even when mortgage interest rates have been high. During last year, however, mortgage rates decreased to 2.96%, increasing First American's revenues to an all-time high of $9.2 billion. This has shown that if interest rates are scheduled to rise in the future, First American's revenues and performance should not be impacted as negatively as other companies within the insurance sector. Moving on to economic outlook. With First American's business model heavily tied to insurance transaction activity, their performance is reliant on the future state of the insurance business as a whole. Through our research and forecasts of the metrics of HPI, GDP, wage rate, and unemployment, we believe that the insurance sector will only continue to grow in transactional activity, offsetting forecasted interest rate growth. And now onto their disciplined M&A strategy. First American has continued to deploy their strategy, acquiring companies that can either speed up the transactional process of insurance or expand First American's global outreach to local markets. This disciplined M&A strategy has led First American to acquire companies such as Endpoint and Docutech, contributing to paperless solutions, which led to more transactions digitally. First American has also recently acquired Motherlode Holding Company, a local title insurance company with multiple brands, each leading in respective local regions. By acquiring a dominating local company, First American seeks to increase market share marginally against its other competitors in a saturated market. We will now present our ESG section.
First American has received a total ESG score of 41 from Refinitiv, environment receiving a 19, social receiving a 51, and environments receiving a 38. And now on to environment. First American is not doing enough to uphold environmental standards. Although they push improvements in certain environmental metrics from their headquarters, there are no publishings of quantifiable metrics that targets the company wants to achieve in the future. Each one of these metrics have not contributed to the company's overall strategic goal or have been integrated in the company's main business operations worldwide and have only focused on being environmentally friendly at the company's headquarters. Social. The company seems to do the bare minimum for the community. While 70% of employees are women, only 53% of women account for mid-level management, 64% account for frontline and supervisor, and 20% account for board of directors. Charitable donations could be more. During the pandemic in 2020, First American sponsored 6 build events and donated a total of $161,000 to Habitat for Humanity, Feeding America, and local communities, despite having revenues of $7.1 billion. First American also lacks workplace diversity, as 71% of employees are Caucasian and the other 29 account for minorities. There should be more incentive from the company to employ more diversity. Governance. The governance structure consists of a 3-person executive management team with Kenneth DeGiorgio, who recently replaced Dennis Gilmore as acting CEO, and a board of directors composed of 10 people, including ex-CEO Dennis Gilmore and former ex-CEO Parker Kennedy, acting as chairman emeritus. Although we view the structure of the upper level management to be strong, the inclusion of past CEOs as chairman of the board represents a conflict of independence. And now we will present our financial analysis.
One of the most critical components of this analysis was projecting mortgage interest rates. Successfully forecasting the mortgage interest rates enabled our team to forecast First American Financial's revenue. In order to forecast the mortgage interest rates, the team started off by reviewing the Fed fund rates that were published on December 15th, 2021 at the Federal Reserve's FOMC meeting. From there, we were able to tie the Fed funds rate to the 3-month Treasury and the 3-month Treasury to the 10-year note. Lastly, we tied the 10-year note to the 30-year mortgage interest rate. In addition to our analysis, we also completed a market survey that illustrates the various published opinions of mortgage interest rate forecasts by numerous industry experts. Our team has also used a regression analysis in Excel, where we use multiple economic indicators to forecast the revenue related to refinance activity and a separate revenue forecast for the purchase activity. We pick the best indicators that demonstrate the strongest correlation between the overall economy and the real estate market. 2021 was a record year for First American, with reported revenues at $9.2 billion. Our team has forecasted declining revenues for the next 4 years. While this forecast initially may sound grim, these declining revenues are still well above their previous record year of 2020, when the company reported revenues of $7.1 billion. First American's revenues are broken into several segments. They are refinance and purchase revenue, specialty revenue, and investment income. Our team's 2021 estimated forecast of $9.12 billion was closer than the forecast provided by Bloomberg or CapIQ, and was less than 1% from the actual revenue of $9.2 billion. Now we will be presenting our evaluation section.
Based on estimated cash flows, we have conducted a DCF model, which will allow us to consider the FAF's stable future growth. With a cost of capital of 7.22% and terminal growth rate of 2%, we have derived our 12-month target price, which is $94, with an upside potential of approximately 24%. And this is based on the price of February 9, 2022. Since this company is trying to expand its ability to serve customers throughout the US through acquisition, it will help them to grow more in the future. We have captured this probable future growth activity through sensitivity analysis, which would result in share price appreciation more than the target price. To confirm our target price that we got from DCF, we have conducted relative valuation using PE and EV to EBITDA multiples and compared those with the industry multiples. Based on our analysis, both multiples are undervalued and makes FAF more attractive as a potential investments. According to EV to EBITDA multiple, the target price is approximately $98, which supports our buy recommendation. Additionally, we also have conducted a bull and bear case scenario. Since this company is highly correlated with the economy, for the bull case scenario, we are hoping that the economic condition will be more favorable for FAF. It will be able to engage in more acquisitions and also will be able to reduce operating costs due to operational efficiency. After considering all those factors, the target price becomes $117 with an upside potential of 47%. And if the opposite happens, then the target price will drop to $73 with a downside potential of 8%. Now we will move on to investment risks.
We identified 5 main risks to investors, with the main ones being mortgage interest rate and labor market sensitivity. Both have been already identified and forecasted within our DCF regression valuation. We classify the rest of the risks as either low or moderate in both probability and impact, as they are based on past events that we believe First American has learned from. In conclusion, with our financial analysis and valuation supporting our investment thesis, we offer a buy recommendation on First American Financial with a target price of $94. Thank you. The team would be happy to take your questions.
Raymond, I think you're up.
Yeah, I'm just trying to find myself. Thank you.
Okay, no problem.
Thanks, guys. Thank you for the presentation. It was mostly clear to me, and I don't think everything was clear, but I think good job. I like the conclusions. You have a firm price. I thought that was good. I have a couple of issues. Please be very, very careful. You're playing in an international field. You need to make sure that there are no errors on your slides. I saw one spelling error at least on one of your slides. So please just check that, page 7. Could I ask you, please, what is happening to the PNC business for this company?
Do you mind to repeat that question? I'm sorry.
Yeah, what is happening? The company's divided its segment, its specialized segment. What is happening to the PNC business in this company?
David, would you like to take that question?
I can attempt to answer that one. The property and casualty segment makes up a very small percentage of this company's revenue. 92% of it is related to the title revenue, and there's a small section that makes up for the investment income. The competitors actually had a much bigger section of property and casualty insurance.
Okay, you're not going to tell me that it's for sale and that it's going to the sale will close this year or next year.
I was not aware if it was for sale.
Okay. Okay, just the point, guys, you do analyze a company, you need to know what's going on so when you ask a question, you know the answers. Tina, you next.
No, I'm at the end. I'm going to let Priyanka go. She's ready.
Okay, sure. Thanks, Tina. Thanks, Ray. So great job, everyone. And like Ray said, good work. I have a few questions that I'm hoping you can help me with. You noted that the ESG risk was low impact and, I think low probability. Could you talk about how there was, almost 900 million records, there was a data breach. So can you tell me how you're thinking about that in terms of the risk being low and probability being low?
Yes, so I can answer that. So in terms of the investment risks, what I think you're talking about is the last three, the cybersecurity, the COVID response, and the lack of ESG emphasis. So yes, the cybersecurity data leaks, we saw that there was leaks in 2019, but we think that it's improbable that it'll happen again because it took about 6 months for them to get that through with the SEC, and we believe that it was a hassle. So we don't think that it's going to happen again, and it's a very easy lesson for them to learn, even though it's happened already like twice. In terms of the ESG emphasis,
when you say you don't think it's going to happen again, what's the basis of that thought? What makes you think that?
The basis is that they haven't, well, they keep, they just don't, well, the hassle that it took for them to get it through with the SEC, we just don't think that it's going to happen again. And with the new CEO being more geared towards law, we don't think that we think that he'll have an emphasis on just not having any legal issues at all, at least during his term.
Okay, thank you. I have other questions, but I'll turn it over to Tina and wait for round 2.
Okay, can we go to page 22? I think when you were talking about the mergers and acquisitions, I'm curious if you can speak to, they've made some acquisitions, kind of how they've done as it relates to what they paid for that acquisition. Was it, do they pay, fair value? Are they overpaying? I'm just kind of curious how they're doing in that M&A space, since it's,
sure.
It seems like something that's, something that's lending to the upside.
Sure. So that's a great question. It's actually very hard to quantify the returns on these mergers and acquisitions. A lot of these aren't necessary to disclose, as with the Motherlode Holdings acquisition that was done recently. A lot of these acquisitions are smaller title companies, which goes to expand their market share, which will marginally increase revenues throughout the years. But I believe you can, just looking at revenues for 2020 to 2021, Acquisitions that we listed, such as DocuTech, other smaller title insurance companies, have boosted that revenue to those higher levels that you see now of around $9.2 billion.
Okay, so it seems like some of the acquisitions they've made have certainly helped with, the technology side. Can you speak a little bit more about how they're going to increase their market share? Because there's clearly some larger players in this space. So what are some of the, kind of the specific things they're going to be able to do?
Sure. So as you see here on this slide, most of the market share, around 90%, is distributed among the 4 biggest players. Fidelity National is one of their biggest players, but in terms of competitive market share, Fidelity has already started to invest in other industries that aren't related to title. Stewart, which is probably the closest in terms of debt to equity and other ratios, is 1/4 the size. Old Republic is only around 30% of title. So we believe that these smaller acquisitions of local title companies will push First American to really grab all of that market share that the other companies that are not currently focusing on.
Okay. Priyanka, you can go back. Got something else?
Ray, do you want to go?
Yeah, I would just like to ask a question. Thank you. I like the slide on page 16 showing the projection of the mortgage rates. Increasing mortgage rates tends to decrease, theoretically, the transfer of houses. People's, the property market dries up a little bit. What is the impact on what is the impact of increasing interest rates on this business?
I'm happy to answer that question. The impact of the interest rates, as interest rates rise, it's gonna slow down the revenues. The revenues will start declining. As we saw in 2021 and 2020, as the rates were hitting rock bottom levels, a good portion of the revenue was attributable to refinance activity. A greater percentage, more than 60%, was related to refinance activity. And as those rates start rising, refinance activity will start declining, and it's going to put more emphasis on the purchase activity. And to that, the purchase activity, I think, in the short term will still be strong. However, if the interest rates were to climb too aggressively, too quick, that could also harm the industry, but also especially people at the bottom of the market. The entry level buyer, the affordability factor, it's also going to go away.
What is the positive impact of high interest rates on their investment book?
I'm sorry, sir. Could you repeat the question, please?
What is the positive interest rate? What is the positive effect of high interest rates on their investment book?
Well, on the flip side, if the interest rates rise, they also do have a considerable amount of money in investments, which most of their investments are in fixed income securities. They would likely see greater returns in their investment income as a percentage. But as far as the revenues for the real estate related items, it's likely that they would decline.
Okay. Priyanka?
Thank you, Ray. So Daniel, I like that you had split, you looked at purchase and refinancing. I'm wondering if you or anyone could tell me which of those transactions are more profitable for the company, and if you have numbers on what that average profitability is, either per order or for the purchase or refinance.
The slide that's on the screen here is probably the best indicator. As I said previously, probably at the high point, according to the Mortgage Bankers Association, about 70% of the revenues were coming from refinance activity, making 30% on purchase activity. But historically,
not for which is more profitable, not the volume.
Oh, I'm sorry.
I saw the slides. Yeah, sorry to be not more clear. No, it's my fault. Go ahead.
So which one's more profitable?
Mm-hmm.
I would like to answer that question.
Go for it, Tasneem.
Yeah. So for the future years, the interest rate's going to increase. So it's more likely that the revenue from refinance activity will decrease, but the purchase segment can be profitable to some extent, since we are hoping that there will be positive impact on the real estate market. And since the demographics is changing, so more millennials are coming to the market and they're purchasing more homes. So we are hoping that for the next 5 years, the purchase segment will be profitable if we compare to refinance activity.
Thank you. And I'll leave the time for Tina.
I'm actually good.
Okay, then I'll go.
Yeah, I didn't have anything else.
Okay, I'll go. I have several.
I do
So
not.
I'm going to push back a little bit on the, some of the inconsistencies, and maybe I just didn't understand them. So I heard Sean say that there have been strong revenues, but then I also heard someone else say that there have been declining revenues. Also saw on one slide that interest rate, despite interest rate being what it is, they have been able to do well. But then Daniel talked about interest rates being what you were using to
Time's up.
get. Okay, sorry, spoke too long.
Thanks, team. Great
Amazing
job.
job. Great
Great
job,
job, everyone. Thank you.
It was a
Thank
pleasure.
you so
Beyond
much.
fabulous.
Thank you very much.
We really
Thank you.
appreciate that. Thank you so much.
Good afternoon, I'm Ethan Mel, and I'm accompanied by Nick Francis, Payne Chen, and Roman Dvorsky. With anticipated macroeconomic headwinds, an increasingly competitive industry, a failure to diversify outside of talent insurance, and lack of transparency, First American is facing significant downward pressure on their stock price. We're initiating coverage on First American with sell recommendation at a target price of $62, representing a 12.42% downside from the closing price of $70.79. First American was founded in 1889 and has become a leader in the talent insurance and escrow industry, second only to Fidelity. First American's success can be attributed to their nationwide network of title agents and ownership of comprehensive historical data, commonly known as title plans, which continues to expand through their data acquisition strategy. The company attempted to diversify into home warranty and P&C insurance, but is divesting out of the segment due to unprofitability. First American's banking division, First American Trust, FSB, operates in an off-balance sheet SPV referred to as HOLCO. The SPV holds the company's debt, escrow deposits, venture investments, and fixed income portfolio. Additionally, nearly 95% of the company's revenue is derived from within the U.S. Talent insurance policies are single premium policies with no specified duration and are heavily driven by agent relationships. Due to the low claim rates, costs are primarily driven by underwriting and SG&A expense. First American's banking division allows the company to perform in-house escrow services to facilitate the closing of real estate transactions. Title order volumes are affected by mortgage refinances and real estate transactions. These are driven by mortgage rates, housing affordability, new home builds, as well as lenders' liquidity in secondary markets. With anticipated interest rate hikes and Fed tapering in March, it is expected that rising mortgage rates will lead to a decline in housing affordability. New home builds are expected to decrease due to rising construction costs, and additionally, we forecast lenders' liquidity in secondary markets decreasing. These macroeconomic changes are expected to lower loan originations and refinances, placing meaningful downward pressure on demand for title and escrow. The top four players in the title and escrow industry account for over 85% of the $19.2 billion market. However, in recent years, small regional title companies have captured an additional 9.71% of the overall market, forcing larger players to adapt by growing their top line through acquisitions or offering ancillary products. While First American's peers have experienced minimal change, the company has experienced a decline of 5.1% in market share since 2019.
And unlike their competitors, First American has failed to diversify beyond title insurance, as demonstrated by the $73.3 million loss in their specialty insurance segment. These losses can be attributed to poor underwriting, which led to a reactionary purchase of expensive reinsurance policies. The company was unable to sell off the segment and is now divesting through book transfer agreements. Meanwhile, competitors have diversified and expanded their products to minimize the macroeconomic impact on the top line and create dedicated channels for title and escrow. For instance, Fidelity has successfully expanded into mortgage underwriting, annuities, as well as life and P&C insurance, creating a diversified business which is well insulated against downturns in the title industry. While competitors have a clear strategy, First American has demonstrated a lack of transparency to shareholders, as the company is unclear regarding their strategy and guidance. Few details are provided regarding the company's direction, and acquisitions within their data space have had minimal accretive impact on the company. There's also little information on deposits in the banking subsidiary, and earnings releases are relatively inconsistent in terms of the data that's reported. No distinction between their title and escrow revenues, selective reporting of venture investments, undisclosed escrow deposits, and no distinction between fixed and floating rate policies leads investors to have to blindly trust management's vision to grow the company. This asymmetry in information leads to a higher required information risk premium for investors. And investors may have a hard time trusting management, as the company was fined by the SEC in 2019 after over 800 million sensitive documents were exposed due to a data breach. A system vulnerability was discovered in 2014, but was not patched until 2019 after the data breach had already occurred. Typically, company policy dictates that high-level risk must be addressed within 45 days. Now, notwithstanding the data breach fiasco, the board of directors and executive team have long tenures with the company and have vast amounts of industry experience. The average tenure on the board of directors is roughly 15 years and is led by Parker Kennedy, who is the fourth generation of the Kennedy family to lead the company since it was founded. Parker Kennedy was the former chairman of the board before becoming lead independent director as of Q4 2021. The executive team's tenure averages out to around 12 years and is now led by Kenneth DeGiorgio after former CEO Dennis Gilmore has stepped down and became the new chairman. The incentives of the executive team and shareholders are well in line, given that 88 and 80% of CEO and NEO compensation is performance-based. The compensation is also determined by an independent committee and is measured against 12 peers to retain and attract highly competent executives. The management team has been highly successful in fostering diverse and inclusive company culture with focus on sustainability. The company, for a third year in a row, has earned a perfect score on the Human Rights Campaign's Corporate Equality Index thanks to its fair and supportive practices for women, minorities, and LGBTQ persons within the workplace. They've also invested in strategic software to minimize paper consumption, such as AsiaNet and Secure Portal. The environmental and social component for First American is a bright spot for the company, as they have the highest performance metrics of any of their peers.
As mentioned previously, over 92% of First American's revenues is derived from their title and escrow segment. In 2020 and 2021, the company experienced unprecedented growth at 42.3% and 30.1% respectively. The majority of the company's earnings are derived from agent and direct premiums as well as escrow fees at 42% and 38% respectively. The remainder coming from information as well as investment income. The macroeconomic factors mentioned earlier are expected to deteriorate, causing First American to experience lower revenues and EPS numbers, with a base case negative CAGR of negative 8.87% and negative 3.35% respectively. These numbers are derived by forecasting the macroeconomic factors mentioned earlier and utilizing a Brownian motion, then sensitivity tested using Monte Carlo analysis, with confidence intervals of 75, 50, and 25% to forecast bear, base, and bull scenarios. These were then used to forecast First American's financial statements and were applied to the financial valuation section, as will be discussed later on. Turning our attention to investment income, the company is heavily reliant on ultra-short duration fixed income securities due to their escrow segment. As a federal savings bank, the company must hold at least 65% of total bank assets in real estate-backed securities. This has forced First American to purchase low-yielding government agency MBS securities, which present an inherent risk if yields on these securities were to be lower than the undisclosed increase in floating rate title policies. Turning our attention to First American's capital structure, debt currently represents 14% of the company's overall capital structure, and it has a weighted average after-tax cost of 1.92%. The company opportunistically increased debt over the past few years due to low interest rates, but we forecast it decreasing as the company pays back certain debt and then doesn't need any more due to their stable critical insurance ratios. Critical insurance ratios used to measure the quality and efficiency of underwriting for the loss expense, underwriting expense, policyholder dividend, and finally the combined ratio, which is a culmination of all the aforementioned ratios. In First American's case, the dividend holder policy ratio is irrelevant, as the company is not a mutual insurance company. Furthermore, the company does not record personnel costs associated with underwriting, and therefore it is not part of their combined ratio. With that said, the team did forecast First American's combined ratio and forecast it staying relatively flat, as is the case with low title claims. Forecasting reserves for losses, we forecast that they will stay relatively flat and decrease slightly due to their exit out of specialty insurance, as well as lower title order volume.
Using the aforementioned forecasted financials, valuation for First American was performed using the dividend discount model, residual income model, market value added model, and relative valuation. All valuation methods were equally weighted, with the exception of the dividend discount model, which represents a 10% weighting. This lower weighting was assigned to the dividend discount model, given that management is not focused on dividend growth, as demonstrated by the historic anemic dividend growth and recent favoring of share buybacks. The resulting valuations were then adjusted for bear, base, and bull economic scenarios, representing 25, 50, and 25% respectively. Dividend discount model is a relevant valuation technique for First American, considering its consistent dividend payment history over the past 12 years. The dividend discount model forecasts a base case 12-month target price of $33.09, a downside from their current price. The residual income model is book value driven, and as such is an appropriate valuation method for valuing insurance companies, as book value of assets and liabilities are often near their fair values. Using an omega of 0.5, the residual income model forecasts a base case 12-month target price of $58.25, a downside from their current price. The market value added model focuses on excess return on invested capital over WACC, making it an appropriate valuation technique for insurance companies. Using a WACC of 7.93%, The market value adder model forecasted a base case 12-month target price of 71.77, an upside from First American's closing price of 70.79. Finally, relative valuations performed using the price to book, price to sales, and price to earnings ratios for First American and its competitors. Relative valuation forecasted a 12-month target price of 65.71, a downside from their current price. Ultimately, our weighted valuation forecasted a 12-month target price of $62, a 12.42% downside from First American's closing price of 70.79. This target price is backed by the anticipated macroeconomic headwinds, increasingly competitive environment from small regional title companies, lack of product diversification, and unclear strategy of the company moving forward. Firm risks for First American include the successful monetization of its title plans beyond simply reducing underwriting costs. Systemic risks include the Fed successfully controlling inflation and boosting First American's title order growth and consolidating the market share by reacquiring smaller title insurance companies. However, any meaningful risks to the upside are purely speculative. With that, we are issuing a sell recommendation on First American with a target price of $62, representing a 12.42% downside. Thank you, and now we'll turn it to you for questions.
Just in time.
Yeah, nice job, guys. Well practiced. All right, judges, it is on to you. Alfonso, you got the time reset?
Yep.
All right, judges, whenever the first of you ask question, time will begin.
Definitely. So echo what everyone's saying, definitely a great job as always. So thank you and congrats to everyone. You talked on one slide about Brownian motion. Can you talk about why you selected that? What is one thing that's a characteristic feature of that? And what's one disadvantage of using that the way you have? That's my first question.
Thank you for the question. So for Brownian motion, we chose to use Brownian motion as it is momentum based and using the four economic factors that we discussed as housing affordability, lenders liquidity and secondary markets, forward-looking building permits, and mortgage rates. We use Brownian motion because it is momentum based, and using the drift mean as we see up here, that accounts for the momentum. And with this, we were able to forecast quarterly for the next 5 years. This is an example of housing affordability, but we did this for all four of the economic factors.
What slide are you on?
Oh,
what slide
number?
This
is the appendix 12. Appendix 12. Sorry about that. So we were able to forecast quarterly each year out to 2025 with a terminal growth rate of 2026 for 2026 at 2.5%. These daisy chain values were then put into a Monte Carlo analysis where we adjusted for sensitivity using 25, 50, and 75% for bear, base, and bull valuations. And then this was able to forecast the total addressable market for the title insurance industry. And furthermore, we were able to use First American's market share to forecast the forward-looking financials as we see in our appendix with the three income statements we have for bear, base, and bull.
And the second part of the question was, when would you have not, what would have made you not use this? When is it not, or what's a disadvantage of using it?
One instance where we would not use a Brownian motion is when the driver variables for the Brownian motion are too skewed. So an important part of our driver variables was they're normally distributed. As we see, if we go back to the Brownian motion slide, appendix 12, we can see that the mean and medians are very close to each other and stacked on top of each other as we see here. This means that all the variables we're using are normally distributed and makes it a great case for Brownian motion along with Monte Carlo for sensitivity analysis.
Over to Tina or Ray.
Tina, you next.
Okay. You want me to go, Ray?
Yes, please.
Can we go back to page 14? I just wanted you to dig in a little bit more because I feel like they're getting really, really high scores here. Can you talk a little bit about, you have 70% of females on the workforce, but how is it represented kind of within the workforce as far as, you know, upper management and the board and what's really the diversity in other segments of the business?
Yeah, thanks for the question. So, sorry, in terms of female in the workforce, a lot of them it's pretty widely distributed throughout the workforce in terms of like middle management, upper management, entry-level employees, and there is also females and minorities on the board of directors as well as the executive team.
Okay, do you have any ideas from a, because I hear they're represented, but anything from a ratio perspective, like, you know, percentage represented?
Unfortunately, we don't have the ratios handy at this time, but we can get back to you with that data.
Okay, that's fine. And then my other question, no, I lost it. Ray, go ahead. I'll come back.
Yeah, thanks. On the PNC sale, or specialty sale, are they selling the home warranty book as well as the PNC book?
They were unable to sell and are actually exiting through book transfer rather than selling off that division.
Right, and if I may add to that a little bit, the company has already initiated transfer agreements and they're expecting it to complete by Q3 of 2022.
The home warranty business as well?
Yes.
Yes, the home warranty and PNC business are both part of the specialty insurance segment, and the entire segment is being divested out of.
How are they going to replace that revenue?
Currently, they're not replacing the revenue, and the current policy that they have at the moment is that they're not renewing the policies that are already there, and they're simply just divesting out of the segment altogether.
Okay, so they lose 130 odd million a year revenue line there. Talk to me about the strategic investments they've made. Can you discuss those, please?
So they've invested in venture investments, but outside of that, they've also invested, they've had a data specific acquisition strategy going forward. The last purchase they had that was a title acquisition came recently, or not, came quite a while ago in 2015, but since then, they've focused specifically on purchasing data companies in order to help automate their title efficiency process to lower underwriting costs. So their footprint in the title industry hasn't been growing, but they've been accumulating more data through commonly known as title plans.
In terms of, sorry, last question before Tina. In terms of if you're wrong, why would you be wrong on the sell?
Sorry, could you ask that question one more time?
Yeah, if you're wrong, say the share price goes up, why would it go up? Where's your risk on selling the share?
For the risk.
Yeah.
Oh, I
So
see.
if I may answer that question, our risk to the upside is, our biggest risk to the upside is the Fed successfully controlling inflation without leading to a recession in the economy. This would ultimately keep interest rates fairly low and housing affordability fairly steady, which would ultimately continue to drive First American's unsustainable revenue growth and title order growth that they've had. However, we are not very confident in the Fed being able to control inflation as they have not shown to in the past. So our risk to while there is risk to the upside, we are very confident in our sell recommendation. And as well as our other two risks, we have successful monetization of their title plans aside from reducing underwriting costs. We know that First American has been in operating for a long time, over a century, and they have enough data to cover 80% of all real estate transactions. So if they're able to monetize that data aside from reducing their underwriting costs, they'll be able to diversify their revenues like their competitors.
Additionally, if I may add, they were able to do this back in 2009 with their spinoff of CoreLogic. So if they have the same, they've shown that they have the capability to do so, but they have not exercised this in a very long time.
And finally, the last risk to the upside we have is them increasing market share by consolidating the industry. We've seen Fidelity do this by acquiring smaller title companies like Chicago Title and others, namely. They've been able to maintain their market share and only go down about 2% in market share, whereas First American has fell about 5% market share by not acquiring smaller title companies to consolidate themselves in the industry.
So in speaking, kind of speaking to that, they've been increasing their dividend. Do you have any thoughts about, should they be lowering their dividend payout? Should be thinking about making some of these more strategic acquisitions?
Based on what we've seen in our model, we think that they should actually just make it a payout of a certain percentage. And based on that, they would cut their dividend. And also recently, management is focused more on share buybacks. So I think that's the direction we believe it should be in.
Okay, so, can you speak a little bit to kind of how they're currently managing their cash flow right now? So I know they've got quite a bit going out to a dividend. Are they doing any kind of other, reinvestment into the firm?
Currently, they are investing in VC investments, but they're a very minimal part of their spending. So other than that, they normally just keep the cash on hand and pay out their usual dividend. And until recently, they weren't buying back shares, but over the past 2 years, they've just begun to.
Got it. Okay.
Please check your spelling on graph 15, sorry, page 15. How are we for time, Alfonso?
1 minute.
Priyanka, you want to ask again?
Sure. So quickly, 2 quick questions. You talked a little bit about the buyback. So what does, buyback implies generally that management thinks the share is undervalued. That's why they're buying it back. How do you account for that in your valuation? And secondly, what is their average profit per order, say, or any specific profitability metrics that you looked at and the trend on that?
Sure. So for your first question was about how, sorry, could you?
It's affected, how is it affected? Actually, sorry, can you re-ask the question?
Yeah, their management is buying back shares. That signals that they feel the share is.
So in the valuation, we forecasted out their share buybacks as part of the income statement and balance sheet, and it affects the EPS numbers. So it is fully accounted for.
Time's up.
And then what was the second half to that question?
That's it, guys. Time's up.
Time's up.
Thanks, guys. Good job.
All right.
Very
well
well
done.
Thank you very much.
Very well done.
Thank you so much, Rob.
Thank you so much.
Alrighty, good afternoon, everyone. Today we'll be stating our recommendation on First American Financial. Up here today is Beach Investment Group analysts Christopher Walcott, Nolan Palmer, Duke Ho, Ulysses Guzman, and myself, Bridget England. Our consensus is that First American Financial is a buy. The company is currently trading at 68 a share, and we have valued it at 86, giving it a 27% upside. First American stands poised to take advantage of short-term and long-term macroeconomic environments through their existing revenue streams and an industry-leading data platform. Jet-fueled revenue streams are powered by large premiums with a high volume of service. To begin, we take a look at the business description. First American Financial generates a total of $9.2 billion in revenue, broken down into 3 parts. The first part of the business is the title segment. The title segment makes up a total of 79% of revenue, broken down into 2 parts. Title insurance contributes 73% of the revenue, and mortgage solutions contribute 6%. Title insurance policies are marketed through direct operations and agencies, with mortgage solutions being a part of the direct operations. Data analytics is another part of the revenue, contributing 13%. First American has created and managed a comprehensive database where customers can pull data for property, which they then use to enhance their business. The last segment of First American Financial is the specialty segment, making up 8% of revenue. The specialty segment is split between the home warranty, contributing 6%, and property and casualty insurance, contributing 2%. The P&C insurance is being phased out by the end of Q3 2022, which will free up capital to put into better revenue driving services. Adding on to the business description, First American has high profitability with a net income of $1.2 billion, which is up 80% from 2020, as well as a net income margin of 13.5% and $1.2 billion cash flows from operations. In addition, last week, Kenneth DeGiorgio has been appointed to the CEO of the company. Kenneth has led the oversight of the international division, trust company, and other various functions. Now passing it to Nolan for the ESG.
We analyze ESG performance through the MSCI key framework in order to identify risks and opportunities. We place special importance on ESG within the title insurance industry as it gives insight into the firm's risk control, reputation, and management team, unlocking greater alpha generation and lower downside risk. First American Financial's environmental responsibility is championed by the First American Planet First Council, which has yielded significant results, reflected in the company's greenhouse gas emissions. In fact, First American has achieved a 29% reduction in CO2 emissions just this year across all 3 scopes. Finally, First American's paperless solutions are creating positive change that's not reflected on the books, as consumers are using less paper and fuel to conduct these transactions. First American's social performance shows promise to the company's diverse workforce. Not only are 70% of employees female, we recognize that First American's employees love their work. This is reflected in the 10% employee turnover rate, the Employee Trust Index survey of 92%, and the 5th consecutive year of being named in the Fortune 100 Best Companies to Work For. First American's otherwise stellar responsibility program is overshadowed by their shortcomings in protecting customer data, which will be addressed later on in our investment risks. First American is overseen by the most independent board of directors within the title insurance industry, with 8 of the 9 board members being independent of the company. Total CEO compensation is an area in which First American underperforms. Previous CEO Dennis Gilmore received $11.2 million in compensation. However, we feel First American's size of operation relative to peers justifies his pay. Company insiders hold a significant 3.93% of shares outstanding, the highest insider stake since going public. In fact, in the last 1 year, there has been a net purchase of 61,000 shares by insiders. We acknowledge this insider optimism as a further reinforcement of our buy recommendation. Using our equal weighting method of E, S, and G, we award First American Financial an ESG scoring of BBB. Insider policy and oversight is encouraging, yet we still acknowledge opportunity for growth within the security space of social impact, as well as board and pay within our governance scope. I'll pass it off to Chris for investment thesis.
Thank you, Nolan. Mortgage refinancers took advantage of the low rate environment throughout 2021. Mortgage purchase applications continue to show resilience in the face of inevitable rate hikes. Consumers are boasting a rock-solid 781 median credit score for mortgage applications, and today, in a market surprise, existing home sales unexpectedly rose 6.7% month over month. We anticipate a FOMO effect from the rising rates contributing to an increased consumer demand for new homes. FAF will benefit from high premiums as households take out mortgages and insurance products together. Additionally, commercial side demand is building steam. The Commercial Mortgage Origination Index posted a 119% year-over-year gain in Q3 2021, reflecting transaction growth across all segments. First American Financial posted a 23% increase in commercial volume and can benefit from increased insurance demand through their business segments. The current commercial environment reveals a tighter supply market than we would typically like. Commercial vacancies and construction completions tell differing stories across segments. Apartment vacancies relative to completions demonstrate that supply cannot equilibrate with demand, putting negative pressures on opportunity for new business. Office spaces also remain vacant as the shift to remote operations is pushing a business away from that real estate. The good news is that the consumer side is showing remarkable toughness. Despite issues, home builder confidence is at a 10-year high, and although home inventories for sale are at a 10-year low, the demand for new homes should be a positive boost to new home building and thus title and home warranty insurance. Cancellation rates are low, backlogs are long, and builders are primed for stable business flows for the coming years. Being supported by these economic drivers, First American generated wonderful returns in 2021. Title volume is up 46% versus the 5-year average, being driven by low interest rates. First American also enjoyed a recent pickup in commercial activities. Finally, the company expanded their footprint with 2 recent acquisitions of title companies. In 2022, we project sources of revenue to move from high volume refinance policies to high premium purchase and commercial policies. We expect purchase transactions to happen at a much higher pace versus the past due to the data integration into their core business, which Duke will discuss now.
Thank you, Chris. We view First American development of the data business as 3 phases. The first phase is collect and monetize data. First American constructed title plan to aggregate data on one platform. Until early 2021, the company maintained around 560 title plans that cover 80% of data. In Q4, the company completed an upgrade to 1,600 title plans over the country that cover all real estate records in the United States. Having data, First American organized and packaged them into accessible database and used them to build data-enhanced platform. Since the mid-2010s, the First American generated revenue through data tree while enhancing their core business with data, especially their mortgage solution wing. This effort allowed the company to grow business while maintaining discipline in the cost. 2020 and 2021 marked the point where First American really
Minutes.
flexed its muscle with acquisition of ServiceMac, DocuTech, Endpoint, and Across to Go. These businesses played a huge role in third phase integrate. The third phase, we see the company introduce automation solution across multiple verticals. We see that company will most likely use automation to shorten the length of transaction from multiple days to much shorter for transactions such as residential purchases. We project information revenue to remain above $1 billion in the future while increasing being less dependent on real estate activities. The data will allow for First American to generate excellent margin throughout the business. Onto valuation, we use price-to-book multiple projection for 2022. We estimate book value of $6.3 billion for $57 per share. Applying industry average of 1.5 brings us to a price target of $86. We also constructed a scenario analysis to gauge the outcome of the different economic condition. Detail will be provided in the appendix. Now we'll pass the presentation on to Ulysses.
Thank you, too. Several investment risks have been brought up for First American, one of them being COVID-19, as is the primary concern for the whole economy. An increase in COVID-19 cases will be the cause in the real estate market, supply chain congestion, labor shortages, and economic closure. We're running a regression between First American and the Vanguard Real Estate Index Fund, ticker symbol VNQ, and we noticed that 80% of First American is correlated to the real estate industry, which means that if the real estate market were to slow down, 92% of First American's revenues will be at risk. Inflation at 7.5% has the effect of reducing the household's purchasing power. From the graph, we see CPI numbers staying in a consistent uptrend year over year, which can cause a negative pressure on durable goods purchase and thus decreasing transactions of title insurance. In regards to privacy risk, in 2019, First American Financial was subjected to litigation following a data application vulnerability that exposed over 800 million title and escrow document images dating back to 2003. Security personnel were aware of this for months without remediation. First American Financial paid a $500,000 fine for this event, settling out of court, but they may be paying a far higher price when it comes to the customer base, and that's the loss of customer trust. But without further ado, we'll open it up to questions.
Time's up.
Dang, good timing.
Very well done.
Yeah.
Very well done. Congratulations to everyone. Great presentation. Love watching it. Couple of quick questions. First one, you talked about how the commercial sector wasn't doing as well, and on another slide you showed that the profitability of the commercial was like 16,000, whereas refinance and purchase was 1 and 3,000. So that's almost an order of magnitude difference. Could you talk about how you're looking at that? You have a buy recommendation and you're saying commercial is most profitable, but it's not doing so well. So talk to us about that a little more.
Absolutely. So through the COVID-19 pandemic, commercial real estate transactions really slowed down. Mortgage origination index was down. So while they do receive more revenue from commercial transactions, they actually are doing less. When we were looking at the title insurance, we were seeing a lot more residential transactions than we were commercial. What we are noticing now is that there's a shift as businesses begin to reopen, that it is actually a shift back into some more commercial, which is that high premium, high volume that we were talking about in our thesis.
Just to follow up, do you know how the size of the commercial orders has been? Has it been the same compared to previous year? Has it been more, lower?
It's depending on the segment. So office spaces, for example, completions across the board have been down for apartment, retail, and office spaces. Apartment vacancies are really low, and their completions are also very low. So we're not seeing that space being able to capture some new business, and kind of the inverse on office space, where the shift to remote work is actually kind of pushing people away from utilizing office real estate. So as things start to, the supply chain congestion begins to loosen, we anticipate some more apartment completions in the future, which would have title insurance products attached to those.
To add to Chris' information, so in the earning release last Thursday, so what drive the outperformance for First American was commercial. So with commercial revenue being up 60% year over year versus 2021. So we see like very healthy commercial revenue stream as like commercial real estate company continue to emerge from COVID-19.
Thank you. I'll yield the floor to other judges and come back with other questions as time permits.
Okay, thank you. So I loved, you spent a lot of time on ESG, which was great. I learned a lot, but I was wondering if you could spend a little bit more time on the valuation. If you could go back and just kind of speak to some of the assumptions that were made and how you came to the conclusion. I'm not sure I got a full grasp of that.
Are you guys able to see my screen?
Yep.
Okay, great.
Go to Appendix 3B.
Okay. B.
Yes, so this is our base case.
Great.
So we expect like a relatively strong residential and commercial. Commercial grow around like 8% and 8% revenue growth rate. So the 8% for purchases of residential come from Mortgage Banker Association estimation of growth rate in commercial mortgage volume. Commercial, we decided to be a little bit conservative because as much as we see like really strong number in commercial, we still like on a wait and see as the commercial real estate market continues to emerge. So the growth rate for commercial title revenue would be much higher. And then for refinance, so across the board, like when we survey Mortgage Banker Association, we see like a 45% decrease in revenue. All in we're looking around like a 20% reduction in revenue for in revenue in 2022. However, the quality of the revenue would be much higher due to the high premium coming from purchase and commercial.
Okay, so you used just kind of one evaluation model.
Can you go to my scenario analysis?
Yep.
Yeah, so we have like the price to book multiple and then like our model and now second model scenario analysis. So we try to be like as granular as possible and model as assumption for like eight different driver and like we throughout three cases, the bear, best, and worst case, and bear, best, and base case, and our range is from like 144 to 122. So our price target at 186 is basically in the middle, and our earning purchase estimate is around $6.7, and our price equity multiple is like 12.
Got it. Okay. Okay, thank you.
Yeah, thanks, Tina. Can you go to page 26 just for a quick moment, please? What is that graph showing at the bottom? I don't see any vertical axis.
Oh, those are the breakdown of the title revenue. So the vertical axis is basically like dollar amount, and what we try to explain in this chart is like information revenue, but to be less dependent on real estate activity and play a larger role in the overall revenue stream of First American as they continue to roll out these automation solution with service pack, endpoint, and DocuTech.
Could you explain what a title plant is? It's a new concept to me.
Title plant is basically just their way of like collecting images and records from public database and put them to like into like the company owned database, and then like the company spent around $585 million on like building out the title plan, like setting up the software and stuff like that. So in the upgrade from 560 title plan like earlier in the year to 1600, the company didn't really have to spend much money because the title plan images have been like created and like designed. So the implementation of new title plans to like expanding the database is like really cheap as compared to like the development.
Okay. Can I ask another question taking on from Tina? This company pays dividends. This company has debt. Why didn't you use a discounted cash flow model for your analysis?
So insurance company, we find it's difficult to estimate free cash flow for the company because we don't find that we could do a precise job of estimating capital expenditure along with cash flow operation because the cash flow is quite volatile, especially with all the changes in the business.
Okay.
Due to the nature of financial companies, some of those values, like Duke said, are a bit volatile. So we use a different model for our financial companies than we would for other sectors with more traditional cash flows.
You don't think you could have modeled around that?
Yes.
My subsequent question would be, how much money does they take each time they do a title change?
Oh, title? Yeah, right here. So as you can see here, the number on the right, there are revenue per order. So in 2020 and in 2021, the revenue is mostly driven by refinance with $1,200 per order. So since the third quarter and fourth quarter, we see that revenue transition more toward purchases and commercial, was bringing $3,000 per order and $16,000 per order respectively.
And that's a very good slide.
Yes. So even with the reduction in refinance activity, as you can see in the middle column, we still confident that the purchase and commercial will do a great job at offsetting for First American.
And that's really the key. It's the offsetting of that refinance market. During the low rate environment, we did see a lot of volume on refinance, people taking advantage of the very low rate. We're going to begin to see a transition towards purchase and commercial, where they actually have more revenue per order.
What about share buybacks?
Share buyback, you go to the appendix first. So it would be a usage of cash flow.
Time's up.
That's it, guys.
Well, thank you, judges.
Nice job today, everyone.
Thank you.
Nice job, everyone.
Nicely done. Aloha from the University of Hawaii at Manoa. We are here to present a buy recommendation for First American Financial Corporation. Our valuation gives a target price of $94, which is a 30% upside. There are three main factors driving our recommendation. First, FAF is an industry leader in fintech innovation. Second, the stock is a value play on a growing US real estate market. And finally, the company has a strong cash flow generating business model. The majority of FAF's revenue is generated by title insurance premiums and escrow fees from residential and commercial real estate purchases. These premiums and fees are based on a percentage of loan size for each of the sales. Therefore, revenue is closely tied to real estate prices. The title industry has historically been very consolidated. Access to title plants and long-term relationships with realtors has created high barriers of entry. Market share has remained relatively stable, indicating that the industry has yet to be disrupted. Now we'll take a look at how FAF is differentiating itself in this oligopolistic market.
The industry is currently trading at a significant discount with a PE of 7.6, reflecting the misconception that outside fintech players will disrupt the inefficient title industry. However, investors should note FAF's deep commitment to innovation, evidenced through their unparalleled portfolio of 30 patents, as well as their recent service acquisition, which will propel their innovation in mortgage solutions. FAF itself is the disruptor. Due to team's original research, we found in a survey that intermediaries in the closing process strongly favor an efficient and simple deal process when selecting a title company. FAF, therefore, is appealing due to its vertically integrated processes facilitated through various platforms. FAF is able to secure its position as a title company with the strongest data foundation through the highest ownership of title plants and various data analysis solutions. This is a data-driven industry, and FAF is the data leader. From our team's research, we also found that realtors value a process that incorporates both digital and in-person elements instead of a merely digital process. FEF has a competitive advantage due to its significant brick and mortar presence, which has grown through the recent Motherlode acquisition.
FAF's business is closely tied to the U.S. residential and commercial real estate markets, which we expect to grow and push FAF's revenue. Two of the largest demographic segments in U.S. history are entering the home buying market: millennials, who are reaching peak first-time home buying age, and baby boomers, who are retiring at record rates and looking to downsize and move. These two groups will drive housing market sales even as interest rates increase. Historically low inventories will keep pushing home prices higher, directly impacting FAF's premium and fee growth. In terms of commercial real estate, in 2021, FAF saw a record number of commercial purchases. With inflation running close to 8%, capital continues to flow into the commercial real estate space. Investors are hungry for this asset type as it is a hedge against inflation. We expect transaction volumes to increase to nearly $600 billion in the next year.
High revenue per order from commercial purchase and large volume of residential purchase order were the major revenue generators in 2021. Over the next 5 years, we project real estate demand and price will continue increasing, driving a top-line revenue CAGR to 6%. In 2020 and 2021, provision for policy losses increased due to the uncertainty around COVID. However, the pandemic did not increase claims, so FAF is now in an over-reserved position. With the improving economy and stabilization of claims pay, we expect FAF will reduce provision expenses over the next several quarters. Fintech requires significant initial investment in software and R&D, but establish a business model with much greater economy of scale. FAF is now reaping the benefit of their fintech investment. Revenue per employee is growing, and personnel costs are stabilizing. The title insurance and escrow industry is not capital intensive. At FAF, CapEx is less than 2.5% of revenue, which is even lower than the industry. FAF has no inventory, and current liabilities are higher than the current assets. Therefore, FAF generates positive cash flow from operating working capital. We project free cash flow yield reaching 22%. As FAF generates strong cash flow and maintains a 70% of retention rate, we project a limited need for external financing. With approximately 70% of existing debt maturing by 2024, leverage will be reduced. We forecast that FAF will also expand their liquid debt security investment to take advantage of their rising interest rate. This will increase investment income and improve their liquidity. We project FAF will maintain a stable cash ratio and keep claim reserves strong. With debt falling and cash flow increasing, free cash flow will jump to well over 2 times that by 2026. FAF's credit range will improve to AA- range. Reducing finance risk means lower beta and higher stock price.
Valuation is based on 4 main factors: ability to generate free cash flow, decreasing financial risk, strong equity base, and its position as a value play on the US real estate market. Moving on to our valuation breakdown, FAF is mature, transitioning to the free cash flow generation phase. To reflect this, we weighted our discounted cash flow model at 30% as an in-depth look at their ability to generate future flows. We also weighted a one-year price to free cash flow multiple at 20% to incorporate what the stock is currently trading at. With a growing 2.4% dividend yield, there are a significant number of income-driven investors in FAF stock, supporting our dividend growth model weight of 30%. Finally, we weighed the traditional price earnings multiple at 20%, giving our market-driven multiple valuation methods a combined weight of 40% and our projected growth valuations a 60% weight. FAF has shown 5 years of free cash flow growth and has broken a negative first quarter trend. If we look at the data keeping cyclicality in mind, we can see that during each year from 2017 to 2020, their quarter one cash flows plummeted. In 2021, they broke that trend with free cash flows of almost 200 million, and we see the positive turnaround continuing in 2022. FAF's market risk is overstated and will decline over time, so we adjust our beta by unlevering it at the current debt to capital ratio and relevering it using 2022's projection. The decline in market risk should provide a boost in the stock price. Our free cash flow for 2021 is very large due to the IPO and sale of their subsidiary for 600 million. Our projected revenue growth for 2021 is 22%, with free cash flow continuing its growth in the short term at 5%, then returning to a constant terminal growth rate of 1.5% after 2026.
Our relative valuation shows the industry trades at a significantly discounted PE versus the S&P. Focusing specifically on the price to free cash flow multiple, FAF is cheap relative to the industry. It is an excellent real estate and fintech play at a great value of only 8.6 times free cash flow. The last takeaway factored into the valuation section is that FAF is positioned to return capital to shareholders. They have a strong cash position, a relatively low dividend payout ratio, both historically and compared to industry averages, a strong equity base, and their ability to generate free cash flow will continue its upward trend. We tested relevant variables against the stock price and found that real estate prices have the largest effect. The largest pricing fall was in 2008 with a 9% downward impact on price. And though it is unlikely, we tested the impact of a similar scenario. Next, Devin will discuss the risks.
We've identified two market risks in our buy recommendation, being rising interest rates and real estate affordability. Firstly, rising inflation rates cause interest rates to increase, which has an inverse correlation with refinance revenues. Within refinance revenues, residential refinance is much more susceptible to interest rate change than commercial refinancing. The majority of commercial refinancing is non-callable 5 to 10 year loans refinanced at maturity. Commercial refinancing revenues will help offset the drop in residential refinancing revenues. Another shield against the risk lies in the debt securities portfolio. Rising interest rates have a direct correlation with investment income. FAF has bolstered their investment portfolio by over $3 billion, taking advantage of the rise in interest rates. For these reasons, we do not see interest rates as a significant risk. In regards to stock price to interest rates, we found no direct correlation. Our second market risk is a potential drop in the real estate market. Rising interest rates and increased millennial debt have created a poor environment for home price affordability. The home price to income ratio is an all-time high, 30% above the historical average. And although these prices continue to increase, we believe low interest rates combined with rising wages has created the ideal environment for mortgage payment affordability. Mortgage payment as a percent of household income has dropped from 50% in 1985 to only 25% in 2022. For this reason, we do not see rising home prices having a negative impact on the real estate market. Next up, Lydia will explain FAF's ESG position.
FAF makes emissions improvements every year using data management systems. For their paperless transition, they have invested into digital solutions that have led to the decrease in 26 tons of waste from 2019 to 2020. FAF is also an industry leader in diversity. Through various initiatives, they have a workforce and leadership that is diverse in terms of gender and ethnicity. Lastly, the highlights of corporate governance include a nearly fully independent board, several technology experts in leadership to support fintech development, and a substantial amount of performance-based pay. Based on team analysis, we give FAF a score that's competitive to its greatest industry competitor. Despite weaknesses such as the comparatively low amount of total share ownership from the board and executives, FAF ultimately ranks slightly higher due to the fintech play into sustainability, a more diverse workforce, and higher board independence. FAF is a strong cash flow generating value play on the real estate market with a fintech kicker. We rated a buy with 34% upside. Thank you, and any questions?
Great presentation, group. So judges, it is up to you. Alphonse is going to restart the timer, and the time will start as soon as the first judge asks their question.
You okay if I get started, guys?
Yeah, Kina, you are.
Oh, okay. Can we go back to the nice job, everyone, by the way. Thank you for all the work that you did. Can we go to the beginning and the overview? I want you to kind of help me understand. You talk about them being a fintech leader, being very innovative. Can you kind of help me understand, how they got there and what's really behind that assessment?
Yeah, I can take that question. Thank you for asking that. So right now, the popular belief of the title industry is that it's a very inefficient industry and that outside fintech players are going to disrupt the industry. However, we want to take a contrary position and fully state with confidence that it's actually FAF itself, which is the disruptor of the industry. And this has been evidenced in multiple ways. They invested $220 million up to date into the title service company that innovates the closing process. And if we want to use a good comparison, then we also used patent portfolio as a way to compare how they're performing in terms of innovation. Right now, FAF's portfolio contains more than 30 active patents. 2 were awarded recently in December alone. And on the other side, you can see that their competitors actually are lagging very significantly much behind in terms of patents. So we can see that through innovation that FAF will be the disruptor in the industry, and it won't be other outside players that will be doing so.
So, I know Fidelity National's probably the biggest in the space. And I don't know if you have a kind of a thing on market share, but I think they've got, probably a good chunk of the market share. How are you, that's the number of patents, but, are they really an industry leader in this space, or are they doing what they need to kind of keep up with where the industry is going? Because obviously technology in a lot of these ways is moving in this in a lot of variety of industries. So I'm just trying to kind of make sure, I'm trying to understand if it's them completely paving the way, or if this is where they need to be be competitive.
Yeah, that's a really good point. And if you look at this graph, you can see that the market share has been consolidated by 4 of the top companies in title insurance for a very long time. And yes, it is true that Fidelity National is gaining the highest market share, but First American isn't too far behind. And I think right now, this statistic reflects the perception of FAF that they're not really going to be disrupting the fintech industry. But I think that once investors realize what FAF is doing right now in terms of innovation and how they can revolutionize the closing process, then the market share will reflect that in the future.
Okay, thank you.
If I can add on to that too, do we still have time?
Yeah.
So although it's true that First American and Fidelity National compete very closely for the market share, where it shows is in the margins and in the ESG. So one of the main points of their innovation is their vertical integration through data, which was started back in 2010. And that allows them to save more money relative to their competitors. So although it doesn't show in market share, what market share they do have, they're making a lot more money on.
My turn?
Yep.
Please okay guys, firstly, welcome and thank you for your presentation. I'm a stickler for things like, please put on page numbers so I can actually talk to you about a page. So next time you start this, make sure your professors tell you to put a page number on each page. Could you please tell me what a title plant is?
Okay, so a title plant is like this kind of, it's basically real estate records. So it's not public records like what we get. So companies like FAF or the Big Four, they have access to these title plants. And one of the ways that they differentiate or that they're able to capitalize on this high barrier of entry is by keeping this this stream of data open.
And if I could add to that on really quickly, could you flip to slide 9, please? The reason why it's so important for title companies to have ownership of title plants is because it gives them a data advantage. And right now we can see that right now FBF is first in their market position to in terms of owning the title plants across the country. And actually one of the reasons why that the title company or the title industry sees so much mergers and acquisitions is because they're trying to get as much title plants as possible because that gives them that competitive advantage.
Could you discuss the IPO you mentioned in one of your slides?
Oh, I can take this question. So the IPO in 2021 is the OfferPad, is a company who can like just handle the also like it's a related in real estate like industry. So this company can bring a lot of like investment income for the company in 2021, but this is only like one-time investment. And since like this new venture investment can help the company to just for their expansion and increase their size and generate more revenue from this like acquisition, new venture investment.
Okay, you there, or can I ask another question? Okay, can you discuss why your WACC is over 10%, please?
Yeah, for sure. So for our market risk premium, I used Bloomberg's estimate of 8.6% because I feel like during recent times it's more volatile. I know it's more common to use 5.5 or 6%, but they take a weekly a weekly sample of the past 2 years. And I think given how turbulent times are, I went with that multiple.
So have you got a set of scenarios against the lower WACC?
We have a lower beta, but not a lower WACC.
Okay. Have you got a graph showing that? A table?
Not including the, well, if you go to slide, let's see, 31. We show the impact on beta on the share price, which is not very much.
Okay. Tina's Branca there?
Huh? Yeah, she's up next.
Thanks,
Can't
Ray.
see- Ah, there you go.
Thank you, Tina. So again, echo what Ray and Tina said. Excellent job on the presentation. Congrats to all of you. I have a few questions. One, could you talk about, you mentioned the, that personnel costs are stabilizing. However, on the earnings call, there was a lot of discussion about expenses. So could you talk to me a little bit about that and how you factored that into your analysis?
Yes, I can take this questions. So since FAF continue increase their investment in fintech technology. Oh, sorry. And so this continued investment can cause them to promote automation in when they're processing their data and processing their orders. So which makes the process become shorter and make everything become more efficient. So even though the company just like keep acquiring more company and do the expansion, and they still have a need to hire more people, but overall they will not hire like too many people, even though like when their expansion is become larger and larger. So overall, we will say the personnel costs become stable because the automation and the processing time becomes shorter, and they can generate more orders to generate more revenue.
So in your view is basically, are they unstoppable, or what are things that would make you say, no, here is when we would sell?
Okay, so I can take that question. So one of the scenarios that we looked at was the biggest impact on price changes. So if you go to slide 31 again, yeah. So we looked at a case similar to 2008 when we saw a large decrease in prices, and it had a significantly negative impact on our target price of 9.5%. So that's the biggest change. And I think Devin can lead in a little bit more on that with the risks.
Yeah, so looking at the real estate prices and how they relate to overall revenues, actually 80% of overall revenues from FAF are residential and commercial purchases. So a large decrease, even maybe 3 to 5%.
Thank you, guys.
Time, guys. Thanks so much for your presentation. Great job, everyone.
Thank you very much.
Hello, my name is Mackenzie.
My name is Justin.
And my name is Leslie.
And we are from California Baptist University. According to the mortgage reports data, 72% of the millennial generation rank owning a home as their #2 goal in life. Imagine if finally achieving this goal, you finally get your dream house, and all of a sudden you find out someone is making a claim on what you thought was your property. With a strong property title insurance policy, there is protection for the lender, home buyer against these problems when there is a transfer of property ownership. With that being said, we are initiating research on First American Financial with a buy recommendation. Our conservative target price for FAF stock is $86 in a 3 to 5 year time frame, with an upside of 26.79% based on our valuation of the company stock. With upward climbing revenues, cash flows, growth, and an experienced team, FAF is poised to continue to be a major player in the industry.
The title insurance industry differs from the more popular property and casualty insurance in 2 criteria. 1, premium frequency and loss rate, and 2, type of insurance coverage. Title premiums are paid only once when the transaction is closed rather than being recurring basis on a recurring basis, like with property and casualty insurance. And for loss rates, title policies occur much less frequent than of property and casualty policies. For policy coverage, title covers historical events in the past until the policy issuance date, while property and casualty policies covers events starting from the issuance date and onward to the future. However, both industries are similar when totaling their loss and expense ratios together, which averagely hovers around 80 to 100%. With that being said, First American's total revenue comes from its title insurance and services segment, which accounts for more than 92% of its revenues in the last 3 years. And amongst its peers, First American meets evenly with its top competitors in regards to profitability ratios, and even leads marginally against its biggest competitor, Fidelity National Financial.
We anticipate First American Financial to continue to outperform their competitors. For the past 2 years, the trend for First American Financial has been a display of highs and lows with a general display of growth. First American Financial is known for their strong customer service. The company focuses on strategic acquisitions that will strengthen the business foundation. In 2020, FAF acquired Tech, in 2021, ServiceMac, and in 2022, FAF will acquire Motherlode in 11 states, continuing to their strategic planning to expand and grow. FAF offers an array of services apart from title and settlement services. This includes services from equity to due diligence to disclosure reports and loss mitigations. Additionally, FAF has a strong dividend payout. Despite the recent events of COVID-19 pandemic, FAF has adapted to thrive under an environment of uncertainty. FAF has grown its dividends every year since 2010. A dividend history like this will attract investors who rely on a portfolio that gives consistent and reliable dividend cash flows.
First American Financial supports sustainability as in a company as well as individuals. From an environmental perspective, First American Financial is ranked best in class in the greenhouse gas emissions among its peers in the industry. The company is heavily involved in making efforts towards environmental sustainability. Some examples include First American Financial having a Planet First Council that focuses on reducing energy, water, and waste across all locations. In an effort to be socially responsible, First American Financial supports the professional development and well-being of their employees, as well as making contributions in the communities in which the company operates in. First American Financial was named to the Fortune 100 Best Companies to Work For and Best Workplaces for Women list. In the company, women make up 70% of their employees, and about 35% of their employees have been with the company for more than 10 years. The company also strives to create a diverse workplace with the intention of inclusivity and diversity. As for governance, the company is governed by a board of directors that are considered to be 89% independent by the Securities Exchange Committee and New York Stock Exchange rules. This ensures that the company is creating value for shareholders as well as maintaining the interests of shareholders. First American Financial also publicly releases quarterly reports regarding the financial performance, risks, and internal controls, as well as other required information.
And considering also governance when it comes to the compensation packages of the executive officers of the company, in 2020, the CEO 12% base salary was set at $1 million, while 88% was performance-based at-risk pay, mostly in the forms of restricted stock units. The same is similar for other named executive officers, whose 20% base salary ranged between $300,000 to $800,000, and 80% being performance-based at-risk pay. We believe that this blend for an executive compensation package provides huge incentive for outperformance and talent retainment within the company.
The uncertainty of COVID-19 has led to previous unfavorable economic conditions. As COVID-19 continues to rise, companies need to continuously be in a state of readjustment. With the unknown that comes with COVID-19 and the unfamiliarity brought with each variant, businesses cannot predict how state regulations and CDC guidelines will impact their business. This may result in First American Financial having issues with their debt or capital. First American Financial also must be up to date about the changes in laws and regulations set into place in order to work and provide services efficiently to their customers. As mortgage and interest rates climb, a decline in real estate affordability is likely to occur. From an insurance perspective, this is a benefit because insurance stocks thrive with rising rates. This is due to a linear relationship that they hold. High competition also remains one of the primary risks that play into First American Financial's risk factors. First American Financial will need to continue innovating and moving ahead of its competitors in order to remain one of the reputable global leaders in their industry.
And over the past 5 years, First American was able to grow its total revenues at a CAGR of 12.4%. And even more so, its after-tax free cash flows grew at 45.93% CAGR. With strong growth in its cash flows, First American is able to continue operations, reinvest in the company, and also maintain its dividend that grew at a 7.74% CAGR over the past 5 years, as well as also afford this dividend as its payout ratio averaged around 30% over the same time period.
As we forecasted out key factors from First American Financial, we utilize a lower and upper confidence. This is an important tool because it helps to display and evaluate the reliability of a particular estimate. ROE offers a useful signal of financial success as it shows how well a company is managing the capital that shareholders have invested. FAF has an above average ROE ratio of 23.09% as of December 2021.
As visible on the graphs from 2011 to 2029, First American Financial will witness an increase of revenue and net income. However, they will need to be aware of their debt to investors at first glance before recognizing that this ratio is increasing due to the continuous strategic acquisitions and company growth.
And when valuing First American from a historical perspective, we utilize the DCF model. And with taking in the 5-year average after-tax free cash flow of $760 million and a WACC rate of 11.10% and a terminal growth rate of 3%, we arrived at an intrinsic value per share of $85.24.
For our relative valuation, we reference models used by American Association of Individual Investors. When accounting for our results, we assigned lower weights to the highly optimistic valuation and higher weights to the lower conservative valuations, displaying our valuation, average valuation, PE valuation, and average PE valuation.
From these two models, we took a 50% weight of our discounted cash flow intrinsic valuation and a 50% of the average of our relative valuation to predict a weighted average valuation of $86.11.
We believe First American Financial, NYSE FAF, is a buy based on our valuation of the company's stock. First American Financial holds a competitive positioning within its industry and has continuously proven to be innovative and quick to meet clients' needs. We conservatively estimate that in a 3 to 5 year period, First American Financial will see a target price of $86. Based on First American Financial's financial condition, performance, and awareness of risk factors, FAF has the potential to demonstrate a higher than forecasted growth in 2022.
Thank you, and we'll now open the floor to questions.
Great presentation, team. With that, guys, judges, I would share, keep your screen up because I'm sure they're going to ask questions. They're going to direct you guys to some slides to help address those questions. Awesome. Time will start when Priyanka asks the first question.
Congratulations to everyone. Great job. I wondered, could you tell me what the percentage of women is on the board? Approximate is fine.
Oh, I'm sorry. It's about 65% as of 2020.
On the board?
On the board of directors, I believe.
Okay. It might be actually closer to like 20, I think, but I could be mistaken. And then you talked about, environmental factors, social and governance. Based on what the industry, which do you think is the most material and why?
So the most important one, I believe, would be a combination of environmental and social. The reason for this is because we are living in a time where investors are becoming more aware of climate change. We're looking forward to investing in companies that are also becoming more aware of that. With also all the social commotion that has been going on with injustice and racial issues, First American Financial would be a good investment because they are more forward-looking company, which is what investors nowadays are looking for as well.
Thank you.
Tina, you're up.
Okay. Can we go to the beginning? You had a slide. And Raymond, I'm going to let you make comments about the WAC. I'm just going to go there. But in the beginning, you had, oh, there we go, market share. So where did this data come from? I guess I'm surprised to see that Fidelity or that First American has the highest market share. I would have thought it would have been more like Fidelity National. They just seem like a bigger name.
Right. I can answer to that. So this is actually just the singular firm's market share. So it's First American Title, its main subsidiary. So, but F&F, Fidelity National Financial, it owns I think the three of the topmost singular firms, which is Chicago, Fidelity National Title, and one other one I don't recall. But Fidelity National Financial do hold a total market share of about 33% in the industry.
Okay.
Yeah,
Okay.
these are the singular firms. I'm sorry. Yeah.
Got it. Yeah, no, that makes sense. And then can you also go to the investment risks slide? So I was hoping you could maybe just elaborate a little bit more, because I mean, I can understand, what the risks are, but I wasn't quite sure how they played into your analysis. So can you kind of lead me to how you took some of these investment risks and how they informed your valuation?
Yeah, so with the uncertainty of COVID-19, it did lead to an economic downturn for the whole country. And since we had to move to digital platforms, First American Financial did make these strategic acquisitions that helped them made an easier transition, not only for employees, but for customers to move to a digital space. So it facilitated it for them. This caused a customer retention. As for the increasing mortgage rates, for those, we determined that those increasing mortgage rates are a result of a recovering economy. And with the recovering economy comes increasing wages as well. Also, the millennial demand for home buying, it will also help mitigate the risk of increasing mortgage rates. But a declining real estate affordability also goes with the increasing mortgage interest rates. And with that, millennial homebuyers have the concept of the fear of missing out on these low interest rates that are already occurring. So this will pressure them into home buying already, which would increase the need for title insurance.
And just a caveat on the increasing mortgage interest rates, we still believe that even though that the spike of the refinancing and the loan originations happened at one same time, like a shock, which enabled a ton of revenue for the company, we still believe that the revenue will not dip down for the future years, because we still believe that the interest rates that the Fed is giving, or the federal funds rate, is still at near all-time lows.
For now. Yeah. Okay, Raymond, go ahead.
Yeah, staying on the slide, what exactly does the slide mean? What does monthly payment 673,754 mean? And what are these numbers, 3,000 going up to 4,007? What does it actually mean?
Yeah, so with this, what we were trying to show is we were looking at an overall house. So if the overall house costed $600,000 and the
But a
interest,
monthly payment of $673.
no, if the house costed that.
Okay.
Yeah, so we were breaking down the monthly payment of the house.
Okay, then you don't have to explain anymore. That's fine.
Okay.
Tell me what this graph of
Yeah, so
high is low. What does this mean, this graph of California?
yeah, so what we were showing here was the increasing, like the declining real estate affordability. So what we were showing here is, well, what does that mean and how can we look at that? So we chose to lay out California, and we can see the darker blue shades are where it's most expensive and the lighter blue is where it's least expensive. So the chart shows the average
Okay,
price.
that's fine. That's fine. Yeah, you just have to explain it. You can't just throw things up. please tell me why your WACC is so high. Gina, thank you.
I think it's, oh, I'm sorry, I can answer that. I believe it's because we gave a margin of safety when accounting for the cap M portion of or the cost of equity portion of the WACC. So it was at 13%, but I gave a plus 2% towards the cost or the return of the market.
What is your risk-free rate here?
The risk-free rate is the average, the 10-year average 10-year notes, which came out to 3%. When considering that, we came to 3% for the cost of debt for the company.
The 10-year note came out 3%, but so is the company paying 8% for its debt? What's it issuing debt at?
It's the long-term debt is at 1.5 billion.
No, that's the amount. What is the rate on their long-term debt?
Oh, the rate?
Yeah, just asking that because your WACC is the highest I've ever seen. I think your WACC is too high. I think if you have got a scenario page showing the difference in different WACCs if you do it at 11, 10, and 9?
No, sir.
Okay, that's fine. Priyanka, thank you.
And you all are doing a great job. Don't be discouraged by the questions. These are really meant to help you, even though it doesn't seem like that. So could you tell me what the pre-tax margin is for the company and what the trends are that you see based on your valuation and analysis?
Do you mean profit margin?
The pre-tax margin, so not the net profit margin, but like before that in the the analysis, it comes before that.
As in operating?
You can pick whichever margin you like and share your thoughts on it. That's fine.
Have you got a graph maybe showing the margins?
Not on here. Well, for net income, looking at this, we do see the overall trend of growth from 2011 to 2021. So with the operating two, it is in the same situation as First American Financial is seeing that uptake in growth due to all their acquisitions and mergers and how they're continuing to operate coming out of the pandemic.
Okay, thank you. I'll turn it over to Tina.
Now, when we kind of speak about the mergers and acquisitions, I know they've made some acquisitions with data companies. Do you have any idea kind of how they're harnessing that data, how that might help them, with their growth objectives?
Time's up.
Oh, dang it.
Thanks, guys.
That one too.
All right.
Thank you, guys.
Thank you.
Thank you.
Great job.
Thank you very much.
Congratulations.
Yeah, very nice job, everyone.
I like it. Cool. All right, so let me get this thing to the actual results. And I think this is actually, it's a fun year to be sharing results because the best written report is not the overall winner. The best presentation is not the overall winner. It is the team that averaged out the best because as a reminder for how the actual scoring works, at the end of the day, it is 50% weighted to written report, 50% weighted to presentation. That does change actually at the next level where it is going to become just a presentation related score. So we submit the written reports, but it's no longer really a factor in who actually wins at the regional level. So I'm going to do it based on first, the actual reports. So the overall best written report this year is from Chapman University. Second place written report was Cal Poly Pomona. And again, you will all get to see all this on the screen in just a few moments. The best presentation score from the judges was University of Hawaii at Manoa. And second place was actually California State University, Long Beach. I can tell you, I think the Long Beach format, actually, I think the judges thought was awesome, guys. So like really good presentation format. The transitions were really sleek and really cool. That being said, so the actual final overall scores came down to within 0.25 points. The second place team overall is University of Hawaii at Manoa. First place overall, like I mentioned, was not the winner in either of the actual reports, is Cal Poly Pomona. Let me, again, I will share my screen real quick. Like I said, I do suggest for all of you to screenshot this when it shows up, because I think it'll kind of help view what was going on in the presentations. There was definitely differences in, in the scores. There was differences in, what different judges thought. What I can tell you, even in the graders, actually at the top. So I don't have, you can't see which grader was by name. You can't see which judge was which judge. I think one of the fun things to look at when you think about the scores, though, is one of the graders is actually an analyst who covers, First American Financial Corp. So, really cool to see kind of how the scoring comes out from an actual analyst that's covering this company, and that they actually gave pretty good scores to all the teams. So you guys, I think across the board for all of you, really just kind of kudos to say that an actual analyst that covers this company read your reports, and most of you got relatively good scores across the board. So that is really fun to see. That is actually grader number 1 on the page if you're trying to see what that actual analyst thought of your reports. Thanks everyone for your time today, and we are all wrapped up. Pomona.